Welcome to the deep dive, where we take complex topics, unpack sources, and really try to unearth the most important insights for you. Today, we're plunging into financial statement analysis. Specifically, we're looking at something really crucial for any company's health. Can it actually pay its immediate bills? We're talking liquidity ratios, a vital tool, right, for understanding how well a company manages its short-term debt. And this is part of, a larger exploration. We're building on previous deep dives into things like horizontal and vertical analysis, those foundational tools. Okay, before we dive deeper, just a quick reminder. This deep dive is based on material from Farhat lectures. All the content, the examples, the explanations we'll talk about today, it's all derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or you're already a professional, you should definitely visit the website. Lots of additional practice questions, video lectures, detailed support. It really helps reinforce today's topic. And a special thanks to Professor Farhat for providing this valuable material for us to explore.
Indeed. And I think to really understand these ratios, we need to look at actual numbers, maybe even play with them a little bit. This kind of hands-on approach, it helps you grasp how changes on the financial statements directly impact these measures. It's invaluable for exams, sure, but also for real-world analysis.
Okay, great. Let's unpack this then with probably the most common ratio you'll bump into. The current ratio. It sounds pretty straightforward, right? Current assets over current liabilities. But I guess the real insight isn't just in that formula, is it? Like, what are some common pitfalls or maybe misinterpretations people make when they just glance at this number?
That's a great question. Because while the current ratio is simply current assets divided by current liabilities, the first pitfall is maybe not fully understanding what's in each of those categories. So current assets, think cash, short-term marketable securities, what customers owe you, that's accounts receivable inventory, supplies, maybe prepaids, things you expect to convert to cash within about a year.
Got it. The near-term stuff.
Exactly. And then current liabilities are the bills due within that same year. Accounts payable, what you owe suppliers, short-term debt, unearned revenues, accrued liabilities, payroll taxes payable, those kinds of things.
Okay, so let's say you have $20 in current assets and $10 in current liabilities. Your ratio is 2.0 or 2 to 1, which means for every dollar of debt coming due soon, you've got $2 in assets ready to cover it.
Precisely. And a key benefit of ratios, as you'll see, is they kind of factor out company size. So you can compare a small local business to, a huge multi-million-dollar corporation using the same metric.
Makes sense.
So if we look at some actual company data, for year X1, let's say the current ratio was 1.04.
Okay.
And then for year X2, it dipped a bit down to 0.97.
Right, and here's where it gets interesting, I think. You can't just look at that 0.97 and say, oh, that's good, or oh, that's bad. Why is that such a critical point?
You're absolutely right to highlight that. That single number, 0.97, it only tells us that the ratio deteriorated compared to X1. It went down. To truly judge it, you absolutely need more information. You need context. Is 0.97 normal for that specific industry?
Ah, okay.
Is the industry guideline maybe closer to, say, 1.05? Context is really everything here.
And I imagine that context, it can vary depending on who's looking, say, a creditor versus an owner. They might see that 0.97 very differently.
Totally different perspectives. From a creditor's view, like a bank lending money, a higher current ratio is usually better.
Safer for them.
Exactly. It signals more cushion, a greater ability for the company to handle its short-term obligations and pay them back. I actually remember a client, a funeral home owner. He had something like 16 different loans he was constantly refinancing.
Wow.
Yeah. And his bank had this really strict condition. His current ratio had to stay at 2.0 or above.
Dear.
And even a seemingly small shift, like reclassifying just $40,000 of debt from long-term to current, that could drop his ratio from, say, 1.04 down to 1.0.
And that puts him in trouble with the bank.
Potentially, yeah. Risk of higher interest rates, or maybe the bank even calling the loan. It just highlights how critical the correct classification of assets and liabilities really is.
Okay, so creditors like it high. What about from the owner's or investor's viewpoint?
Well, from their perspective, a current ratio that's too high can actually be a bit of a concern.
Really? Why is that?
It might indicate inefficiency. Maybe the company has way too much inventory just sitting there, not selling. Or maybe too many receivables that aren't being collected effectively. Customers aren't paying on time.
Or even just too much cash lying idle.
Exactly. Idle cash isn't being put to work to generate returns or expand the business. So a ratio of, say, 3.0, it might actually raise some questions about how well they're utilizing their assets.
So what does this boil down to then? Is there a general rule? Higher is generally better, but there's no single magic number.
Absolutely. No magic number.
Yeah.
Consider a company like Walmart. Their current ratio is often around 1.0, sometimes even a bit less.
Which, if you just looked at a textbook definition, might seem terrible.
Right, you'd think, oh, that's really risky. But for Walmart, it's actually not. They have immense leverage over their suppliers. They can dictate like 120-day payment terms, but they collect cash from you, the customer, almost immediately.
Ah, so they get the cash way before they have to pay their own bills.
Precisely. That strategic imbalance, that business model, makes their low current ratio perfectly healthy for them.
That's a fantastic example of context. Okay, let's move on. Let's get a bit stricter. The quick ratio, often called the acid test ratio. It's related to the current ratio, obviously, but there's a key difference, isn't there?
That's right. The denominator, the bottom number, is still current liabilities. No change there. But the numerator, the top number, changes significantly. For the quick ratio, we only include cash, short-term marketable securities, and net receivables.
So what are we taking out?
We're removing inventory, we're removing supplies,
Okay.
and we're removing prepaid expenses.
Okay. And the assets left. Cash, securities, receivables. Those are the quick assets.
Exactly. Because they can be converted into cash very easily, very quickly. Hence the name.
So why is this distinction important? What does the quick ratio tell us that maybe the current ratio doesn't quite capture?
It measures the company's ability to pay off its current liabilities under, let's say, more extreme circumstances.
Like a stress test.
Kind of.
Yeah.
For instance, what if the inventory suddenly became obsolete? Or what if it just couldn't be sold quickly for some reason? It asks the question, if you could only rely on your most liquid assets, could you still cover your short-term debt?
Okay. And for that company we mentioned earlier.
For our example company, the quick ratio was 0.70 in X1, and then it dipped down to 0.60 in X2.
Lower than the current ratio, which makes sense.
Always. It will always be lower, or I guess equal in a very rare case, but typically lower because you're taking assets out of the numerator.
And that drop from 0.70 to 0.60 suggests what?
It suggests their ability to cover immediate debts without relying on selling inventory got a bit tighter in year X2.
Okay. Maybe their cash position weakened or receivables grew slower.
Could be either, or both. It makes them potentially more vulnerable if inventory does become hard to move.
This is a great point for you, the listener, to sort of practice thinking with the numbers. You mentioned playing with them earlier. So if a company has $100 in current assets, $50 in current liabilities, that's our 2.0 current ratio.
Right.
Now, what happens even to the quick ratio, maybe, if they just pay off a small bill? Say, if $5 in accounts payable using cash.
Okay, good exercise. If they pay $5 cash, current assets drop to $95, and current liabilities drop to $45.
Right.
So the new current ratio would be 95 divided by 45, which is 2.11.
So the current ratio actually went up. It improved just by paying a bill.
It did. This simple exercise of just plugging in numbers, it really helps solidify your understanding. And it's also vital in auditing, by the way. Auditors use analytical procedures where they expect ratios to be reasonably stable year to year.
Ah, so a sudden big jump or a big fall is a red flag.
Exactly. It prompts further investigation. Why did this ratio change so much?
Okay, so the quick ratio is stricter than the current ratio. If it's strict, is the cash ratio even stricter still?
It is. We're tightening the criteria again.
What gets focused on now? Or I guess what gets removed now?
For the cash ratio, we take only cash and marketable securities in the numerator
Wow, okay.
and divide that by current liabilities. So now we're even removing accounts receivable from the equation.
So this is testing a scenario where you basically can't collect what people owe you or can't sell those receivables.
Essentially, yes.
Mm-hmm.
It's asking what happens if only your actual cash and near cash investments are available. For our company in X1, this ratio is 0.14.
Pretty low.
But interestingly, it actually improved to 0.17 in X2.
Hang on, that went up, even though the current and quick ratios went down from X1 to X2.
Yep. Isn't that interesting? It tells us that even though their overall liquidity might have tightened slightly according to the broader ratios, their pure cash position relative to liabilities actually got a bit stronger.
How could that happen?
Well, maybe they were holding more actual cash. Or perhaps their short-term marketable securities increased. It suggests a shift within the current assets.
It really shows you need to look at all these ratios together, doesn't it? Not just one in isolation.
Definitely. You start to paint a much more nuanced picture.
Okay, this is fascinating. But even with these ratios, based on the balance sheet, isn't there an even, maybe better, measure, something that looks at actual cash generation?
Ah, you're leading right into it. Yes, there is.
Huh.
That would be the current cash to debt ratio.
Current cash to debt ratio. Okay.
This one takes net cash provided by operating activities.
Okay, that's straight off the cash flow statement, right?
Yeah.
The business actually generated from its day-to-day operations.
Exactly, the core business cash generation. And you divide that by average current liabilities.
Average. Why average liabilities here when the others use the end of period number?
Good question. It's because the net cash from operations figure covers a whole period, usually a year. It's a flow measure. The balance sheet numbers are just a snapshot at one point in time. So to compare a flow over a period to liabilities, we average liabilities at the beginning and end of that same period. Makes it more comparable.
That makes sense. So this ratio tells us how much cash the company is literally bringing in from its daily work to cover the bills coming due soon.
Precisely. It feels like the most direct test of sustainable liquidity, doesn't it?
It really does, like
Yeah.
the ultimate stress test from operations.
For instance, if a company generates, say, $300,000 in operating cash over the year,
Uh-huh.
and its average current liabilities during that year were $840,000.
Okay.
That ratio is $300,000 divided by $840,000, which is roughly 0.357, or about 36 cents.
Meaning they generated 36 cents in operating cash for every dollar of average current liabilities.
Exactly. And for this particular ratio, unlike maybe the current ratio, higher is generally always better.
There's no too high problem here.
Not really. A company generating lots of cash from its operations relative to its short-term debt, that's almost always a sign of strength. It signifies strong cash generation.
Wow. Okay, what a fantastic deep dive into liquidity ratios. We've really covered the spectrum. We hit the current ratio, the stricter quick ratio, the even stricter cash ratio, and then that powerful current cash to debt ratio using cash flows.
Yeah, and each one gives us a slightly different lens, a different angle
Yeah.
on that fundamental question. Can the company manage its short-term obligations?
And the key takeaway, it seems, running through all of this,
Hmm.
is that no single number tells the whole story. You absolutely need to consider trends over time, how it compares to industry norms, and who is asking the question. Creditor, owner, manager, context is everything.
Absolutely. So what stands out to we listening right now? How might understanding these different ratios change how you interpret a company's financial health? Or, maybe even how you think about managing your own financial situation. There's always more to learn, more to explore beneath the surface, for sure. And to really deepen your understanding, to really practice applying these concepts, I can't recommend farhatlectures.com enough. You'll find a wealth of resources there, multiple choice questions, true, false, video lectures, detailed solutions. It really helps cement the knowledge. Our motto there is saving CPA exam candidates and accounting students one at a time. And the materials are really designed to supplement whatever CPA review course or accounting studies you're already doing.
Definitely worth checking out. Well, thank you for joining us on this deep dive into liquidity. Join us next time as we explore another fascinating area of financial statement analysis, activity ratios. Until then, keep learning.